Hello everyone, I'm Tony Damian.
And I'm Andrew Rich, and welcome to the latest episode of Himalayan Bites.
We're very lucky today, Andrew, to be joined by a special guest.
We certainly are. We've got Guy Miller coming in today from WTW. And Guy is here to tell us all about W&I insurance in public M&A deals. Guy, thanks very much for coming along today.
Thank you for inviting me.
We've all done lots of private M&A deals where we've had warranty indemnity insurance, but over recent years we've started to see warranty indemnity insurance appear in the takeover and scheme space. Guy, why is that?
Well, I think typically on takeover arrangements, it's very hard to get, or very difficult and almost impossible to get specific shareholders to stand behind those warranties. And so what we found is that on uninsured schemes, if there's a breach of warranty, you're looking at potential triggers for schemes falling over and for walk-away rights. And what we found with insured schemes and insured takeovers is that the right of recourse for breach of warranty is to the insurer, and that facilitates the scheme. And the second part is that, and what we've typically found on uninsured schemes, the scope of the warranties are far narrower, given the tensions between the parties. Whereas on an insured scheme, you have a far broader set of warranties, everything that covers the business arrangements, litigation, tax warranties, tax indemnities, and even warranties given on an indemnity basis. And so the insurer will wrap that policy around those general warranties and also around those specific warranties.
Yes. And what about, how common are these? Which industries are you seeing W&I insurance getting taken out in the public M&A space, Guy?
I think, when you talk about industries generally in W&I is very sector agnostic. So there are very few sectors where you don't see insurers having appetite for W&I. In the public to private space, we've had deals that have spanned agriculture, energy, health tech, fintech, and entertainment. So it's very broad. And I think it's just really a question of whether there's appetite to cover a scheme and the target. And if for the most part, you'll find it sector agnostic.
And Guy, a private M&A deal with W&I insurance, a public M&A deal with W&I insurance, what are the main differences in the public setting?
Okay, so the first thing to establish is that the buyer side W&I insurance policy is what we use on takeover schemes and schemes of implementation and arrangement. The key difference is that on a typical buyer side insurance policy, the insurer has a right of subrogation for vendor fraud. And as we established in the beginning, you don't have specific shareholders or warrantors that the insurer can subrogate against in the event of fraud. So what has been introduced into W&I policies that are insured is that the insurer waives its rights of subrogation, and in turn, because it's waived its right of subrogation, it now has a fraud exclusion. So typically, a buyer would benefit from the policy for vendor fraud, but under a scheme of arrangement, it wouldn't. The insurer would sit on its hands in the event of target fraud for a breach of warranty.
Very interesting. Another comment we hear sometimes from clients is that corporate clients have had experience, PE clients as well, it's sometimes hard to sell on warranties against an entity that's giving the warranties. Is it even harder against an insurer? Is it the same? What does it look like at a practical sort of level?
Well, at a practical level, when we talk about claims generally and over the 10 or more years that we've worked on these policies, it's very rare to see a policy or an insurer litigate over a valid claim in an insurance policy. And to be fair to the insurers we've worked with, they've really taken a pragmatic approach to claims. And for the most part, 99% of the time, these claims are settled without litigation. So it's very rare to see one of our claims go to litigation. From a statistical perspective, a broad range, and it kind of ebbs and flows as to where you are in the M&A cycle, but you tend to see about 15% of our policies with a claim notice, and about half of those policies where the claim either has an effect on the retention, the self-insured retention that's been eroded, or there's money changing hands between the insurer and the insured. And that would reflect our global book as well. So I think the US is a slightly different different set of statistics, but Europe and Asia, it's around about 15% of policies with claims.
Interesting statistics there, Guy. You talked about some of the differences between the policies in the public and private space. What about some of the areas that are covered or not covered in terms of warranties?
Yes. So I think, again, if we go back to our basic buy-side insurance policy, which is the one we utilise for schemes and takeovers, the exclusions are really put into two buckets. One is your more general common exclusions, which are hardwired into the policy and are very rarely waived or changed over time. And your next bucket are the more specific, deal-specific exclusions. And so typically your exclusions that are general in nature would be things like knowledge. So it's a knowledge-based policy, just like a sale agreement is knowledge-based. Buyers cannot claim for things that they know about, typical and very established principle. Things like price adjustments, completion accounts, leakage mechanisms, pollution is one that is typically excluded under W&I policies. And things, again, like forward-looking warranties, projections, which you typically find are kind of negotiated out of sale agreements anyway, where sellers well advised they wouldn't agree to warranties like that. And that's where, the policy steps in and kind of sets, it shows what the market, a general commercial market set of warranties. And then the more deal-specific ones, those would relate to perhaps areas of focus in the actual target, and those just vary from deal to deal.
And Guy, one area that we always get asked about in the insurance space in both public and private deals is just underpayment issues. I understand now you are seeing quite a bit of coverage for underpayment issues.
Yes, certainly times have changed. I mean, 2 years ago or 2.5 years ago, these were almost excluded in whole or in part on most deals. And I think what's happened is the lawyers and accountants have really stepped up their game on due diligence, and I think that we've enabled insurers to underwrite to these risks. So you're seeing more cover in those areas. I think that there is always a risk that you do the work, you go into the company, and there are issues. If they are systemic in nature, you're going to still find there's going to be some pushback from the insurers. But I think if there are issues that are easily rectified or have been rectified, then you really stand a good chance of getting cover. In most parts, we're getting cover now.
Well, it's very interesting, W&I, very important in M&A, both private and public. In the private setting, it's enabled sponsors and others to effectively have coverage in place where it wouldn't otherwise be able to be so. And in the public M&A setting, where by definition there isn't really a vendor, again, it's helped to bridge that risk gap. So a really important, I think, and helpful development in our market.
Indeed, Tony. Guy, thank you so much for those insights. Guy Miller from WTW, one of Australia's leading insurance brokers.
Thank you very much, and thanks for hosting. Really appreciate it.
Thanks for coming in. Thanks for watching, and we'll see you next time.